All right, we're going to get started. This idea for the talk today originated with the investment club. We've had various discussions in the past about finances, and specifically we talked the last time about Westminster as it relates to other CCRCs and what a great story Westminster has to tell. We have today invited Chuck and David Redding, chairman of our board, to come and talk to us about specifically those areas, Westminster, and a little bit about the investment portfolio, I hope. Anyone who wants to sign up to participate in our regular sessions should check with, we have a sign-up sheet that we'll pass around. Again, it's open to everyone. So without further ado, let's get started.
Thank you, sir. So I just like to start meetings like this with a little humor. So I thought we'd do that, okay? When I lose weight, I always gain it right back. It's the same for losing money, right? Not so much. Do you know what it means when all your financial statements are in red ink? That it's time to change the printer cartridge. The good news is nobody will ever hate you for being rich. If I buy a glass, do you promise to use the money to grow the economy, create new jobs, and support green initiatives? Remember how much fun we had that night? We slept under the stars. We may get to spend our whole retirement doing that. So Westminster financial performance in 2024 was good. We beat the budgeted net operating income, so that's the margin. We're not for profit, but we're all working for a margin, right? Even us non-for-profits, we're reinvesting in ourselves. You can see here that our budget was for $1.225 million for the year 2024, and our actual was $2.281 million, which created a positive variance for us of $1,056,000, which is good. That deserves a green dot. As a community, that's really good. That's really great when you almost double what your budget NOI is. A lot of that was due to higher occupancy numbers than we budgeted originally, and also an influx of Medicare and private pay in our healthcare center. You've seen this slide before, because when I talk to you about monthly service fee increases, we talk about the revenue, and you can see that, and if any of you that have been with us for a while, you remember this pie chart was almost all blueberries. And now we have some orange in that pie, some gray, and some yellow as well. That's really what the Carlisle expansion was helping us diversify our revenue streams by adding more assisted living capacity, more memory support capacity, and more healthcare center capacity. We were bedlocked in our healthcare center for many years, that we only had enough beds to serve the life care residents, and we couldn't accept a lot of outside admissions. That's changed, and now we're doing Medicare rehab, which we're really good at, and it's very, very great, very good for our revenue stream. Budget expenses, you can see that food and beverage is the biggest part of our expenses. I show you this every year. We are budgeting about $40.5 million in expenses. Since the price of eggs have gone up, the food and beverage part of the pie chart is probably going to get a little bigger, unless you really stop eating eggs, which I doubt we will. Health centers, 22% of our expenses. The healthcare center is expensive to operate because of all of the nurses and the supplies and everything that are necessary to run that. G&A is 20% of our budget, plant operations 14%. Our largest department, though, is food and beverage at 125 associates. We have 415 total, but 125 are working in food and beverage across all areas of the campus. In 2025, we budgeted just a little bit of growth in our NOI. So we're hoping to achieve 1.446 million margin, net operating income for 2025. About 3.5%, which is reasonable. This is a slide showing our days cash on hand compared to others. This is at the end of 2023. And you can see that we are outperforming all of the, really pretty much the industry's peer group, the Clifton Larson Allen peer group, which is our auditor, and the CCAC median. The CCAC median is the green, and our numbers are in the blue. We ended 2023 with 1,004 days cash on hand. We ended 24, which are unaudited financials at this point, a little bit better than that, just slightly. The average age of plant, which is a number that I've been very concerned about over the years, because we have, you know, a Preston building that's a little older. Almost, yeah, it's a little older than I am, put it that way. But it's really a great building, and this number really has stayed pretty steady for us because we continue to reinvest in our capital expenses and do projects to improve the Preston and all of our buildings. The board is very supportive of that. In 2023, you saw a major decline in our age because we brought on the Carlisle, and that helped decrease the age of the campus. Our debt service coverage ratio, again, our number's in blue, and the CCAC median is in green. We're doing very well. 2023 and 2024, we actually ended up just a little bit better than our 23 numbers. And I'll show those when the audited financials come out. And we'll have it in our annual report typically. I wanted to do this slide. I've showed this slide before, but I've never really calculated what it means in the 10 years that I've been kind of tracking this. 2025, we beat all of our competitors and the industry by passing along a 3% increase, even though inflation hit us, everybody hard, and the labor market was tighter than it ever has been. We've been very proactive in managing our salaries and being competitive in the market. The board's implemented and supported a compensation plan back in 2018 before the pandemic that we continue to ratchet up over the years, and it's really helped us and insulated us from these increases that a lot of our competitors are feeling. If you've been here for 10 years, your monthly fee has increased 33% in 10 years. If you lived at Carencia, it'd be 48%. Longhorn Village is 43%. The Village at the Triangle, 49%. The industry, almost 89, well, a little over 89% in the industry.
Hey, can you go back one slide?
Yeah.
That's really loud. All right, that's not gonna work.
Try this one.
Yeah, so if you look in 2023, that was the largest increase that we approved as a board since I've been here since 2013, and there was a lot of discussion about that. We really did not want to do that kind of an increase. We wanted to stay in that 3 to 4%. Chuck demonstrated that we really were going to need it because of what we were doing at the Carlisle, and there was some stuff offline, and
Insurance.
we actually directed him to lose money that year, which was completely unheard of. Our managing group, LCS, was not super thrilled with that, but we felt like as a board that if we showed a positive NOI on the backs of a 6% increase after the market had declined like it did that year, that just wasn't gonna fly. So Chuck did as he was directed, and we came in at about a $600,000, I think, loss that year. And so that 6% was needed to kind of keep things rocking and rolling along. But just wanted to throw that out there to let you know that that number does kind of jump out as you look at that slide. It's certainly in line with what everybody else did, but we don't tend to compare ourselves to everybody else. We like to do it better. So.
This is a slide that's provided by Ziegler, just the CCR peer group comparison in Texas. And you can see that, we're triple B rated, and we overall operating revenue is reported at the 38.5 million. The debt service coverage ratio is better than any of our peers. And our days cash on hand of 1,017 is outperforming almost all of our peers as well. There is about 2,300 CCRCs across the country, and only about 160 of us are rated investment grade. And again, ours is a triple B. We had hoped to achieve a triple B plus. And didn't with Fitch, but our bonds harvested a better than triple B plus, and I'll talk about that in a sec. So what does the Fitch rating mean? Of course, AA minus is best. That's high grade, negligible, risk level. Triple B is a very low to low risk level. When we first started with Fitch, we were double B plus, so a low to moderate risk level, and it's continued to strengthen over the years, which is a good thing for our community. So days in accounts receivable, this is at the end of 2024. Thank you all for paying your bills. We have 8.3 days of days in accounts receivable, which is extraordinary for any senior living community, isn't it, Ms. Pearson? A lot of folks are much more than this. The CCAC median is 18 days, so LCS loves that we're less than 10, and that's with Medicare and insurances. Days cash on hand, we were 1,006 at the end of December, and the CCAC median is 439. And this is after it costing more to run Westminster than it did before the Carlisle existed, right? Because we added associates, we added restaurants, the electricity bill went up, and lots of other things. It costs about $124,000 a day to run Westminster. It's a lot, isn't it? Operating ratio continues to trend down. This is the end of 2024. So 2024 for us was a year of stabilization. We had filled most of the Carlisle. The Windsor expansion had been filled, and we started to bring in revenue in our assisted living and memory support and healthcare. Revenue trended up. And so our operating ratio trended down, creating a margin, which is a green dot. For us. Debt service coverage ratio, we ended the year at 3.90, almost double the CCAC median. So our cash accounts, just an overview of those. I'm not going to go into a lot of detail, but you can see here, this is our debt service reserve for the 2016 bonds. We were sitting at the end of 24 at 5.085 million. Funded interest, 754,000. We have Westminster board designated accounts. One of the most important designated accounts to me is the renew and replacement reserve, which is 12.175 million. So that, I get asked a lot, how can Westminster absorb something that goes wrong mechanically, like the Preston air conditioning plumbing replacement project. This account, they set up this account. We worked together to create this number based on a forecasting model that we created with Brennan, and we have funded this account and have it standing by for anything like that might occur. We have the return of capital reserve, so that is money that's set aside to address return of capital entrance fees. 90% return of capital, which some of you might have, so there's money set aside for up to, it's this $10.5 million that's sitting there for the year's liability in return of capital contracts. So we're always funded. We'll never put you in a queue like some of our competitors do, where you're waiting for a couple years. Upon resale of your apartment, you or your estate will be refunded that 90%. Bond and principal interest, $2.5 million. The friendship fund, I get asked about a lot. The friendship fund is there for you if you ran out of assets. We did an analysis upon your moving into Westminster, where we analyzed your assets and made sure that you were going to be able to afford to live here. If you run out of those assets, we will not throw you out on the street. The friendship fund will kick in and help support you staying at Westminster. We have two people on that right now that are living here. So the custody fund, you can see at the end of 23, we were at basically 81 million. At the end of 2024, we were at 92 million. So significant growth in our funds. Operating cash, this is petty cash, really, it's really petty cash just for cashing your checks. If you still do that at the reception desk. You can see a scholarship fund has continued to grow. Before our 55th anniversary, our scholarship fund set at about $46,000. And on our 55th anniversary, you might remember, we did a fundraising campaign with our vendor partners and asked for $5,500 to honor Westminster on our anniversary to use for this purpose. And they were very supportive of that. All of our vendor partners donated to it. Many of you donate to the scholarship fund on an annual basis. Some folks that stay in our healthcare center that are here short-term rehab, they donate to the scholarship fund as well. So even though we have people using the scholarship fund, which an associate can use up to $5,000 a year, which is a full ride scholarship out of district for Austin Community College. We still grow the fund, which is great. Let's see. We pretty much covered that. I think this one's yours.
Okay,
All right.
great. So Chuck asked me to come and talk a little bit about the bond financing that we just completed with our financing partner Ziegler. Those bonds went to market on Wednesday, and the bond sale was really successful. They were really pleased with how our bonds were received. We actually had one mutual fund buyer that indicated that they would have taken all of our bonds. So a huge vote of confidence to our creditworthiness and the market's ability to see that we've got a quality organization here, and we've got a financially sound house. So the total cost of $43 million was funded through these bonds. The board, typically what happens in a bond financing is all the pre-build costs get rolled into the financing, and we would have gotten refunded for the $4.19 million, which we've already paid in project cost, architecture cost, all the work that we've done on phase 4. But the board elected to go ahead and expense that. So it was basically a capital contribution from our investment fund into the project. We were also looking to contribute another $15 to $20 million out of the accumulated cash. Our investment account has gotten up to about $120 million. And there's a feeling on the board of, how much is enough? Like, how much do we need in that fund? As you all know, that your return of capital is secure, and that typically those payments aren't made until your apartment is re-rented and the new return of capital amount is paid, and then you get your money back. So there's the risk that we're not going to be able to fund those return of capital contracts is pretty small. That doesn't mean we're not gonna keep a significant reserve to make sure we can make that happen, but it does mean that, you know, there's some number that is gonna be enough in that investment fund. So we wanted to contribute a considerable amount of principal to this, to the project, specifically because since I've been on the board and to my knowledge, it's the first non-revenue generating project that we've engaged in. So these are all amenities that are going to be available to all of you, but they're not going to generate any more revenue to the organization. So it's kind of a different model than what we had looked at in the past when you build a Carlisle building and all of those apartments are going to be producing revenue every month, right, to pay off that debt. So we were very careful about that, and the board was very in favor of making a large capital contribution. Ziegler came to us, and you'll see down in that bullet point below the bold area, we had a year ago engaged in a bond repurchase of about $6.5 million for our 2021 bonds. What happened there was, as interest rates go up, bond values go down. So when we issued those bonds at 4%, rates went up to 5+, and those bond values in the open market went down significantly. So what we did is we went out and repurchased about $6.5 million of those bonds, but we only had to pay $5.5 million to get them. So we saved about $1 million in debt on those bonds. We didn't know if we were going to keep them as an asset because we were paying ourselves interest on those bonds, we owned them, or if we were going to cancel that debt. We eventually ended up deciding to terminate those bonds, and they have now gone away. What that basically means is we contributed another $6 million to the project. We went through that same process late last year. We again looked at the 2021 bonds, and they were still trading at a pretty good discount. Not as good as the one. Frankly, the $6.5 million was all the bonds we could buy a year ago. Nobody wanted to sell our bonds. They wanted to keep them, which is another good sign. But we were able to purchase $18 million of the outstanding 2021 debt at a discount of about $2 million. So, and again, these bonds are going to be terminated, and that again is another capital contribution from our fund into this project. And the way that works is it means we just don't have to take out as much financing to fund this project because we're buying this debt back and terminating it. So, you know, the savings on that, $500,000 in interest expense, another $737,000 in interest expense on the bonds we just bought and terminated. So there's been significant savings on that bond repurchase program. So with the debt that we issued on Tuesday or Wednesday, what we were being told in the market is if our debt could be sold for 1% over the municipal market debt rate, which is a AAA tax-free bond issue. So this is the highest graded. If our bonds could issue for about 1% over that, we were doing really good. Our bonds issued for 0.82% over that, which is really putting us into a BBB+, maybe even to a low A category. In other words, Fitch didn't quite see our value, but the bond purchasers absolutely saw our value. And so all of those bonds sold. Our all-in financing cost now over the next, 35 years is down just below 5%, 4.77%, which we feel like is a great number to have locked in. We saved $2 million in purchasing the 2021 bonds. We've saved $530,000 a year in debt finance on the 2016 bonds through the refinance, and then we've another $734,000 a year in the purchase and cancellation of the 2021 bonds. So all in all, our debt servicing costs are going to go down annually for the next 35 years, and we've kind of locked in at we feel like is a really, really competitive rate out into the market. So we use some pretty sophisticated tools, and you know, that didn't go unnoticed by Ziegler and as well as the bond purchasers out there. Several of them were like, hey, isn't this the group that just bought a bunch of bonds from us a couple of months ago? Because these are the same mutual funds that buy the senior living bonds, so they all know each other and know what's going on. And so anyway, we got kudos for that. So I want to switch gears. We can answer some questions on that later if we have any, but we'll switch gears to talk about our investment policy, because I think this this is really what changed the course for Westminster and our investment fund over the last 10 or 12 years. When I came on the board in 2014, 13, we had a very, very conservative investment policy in place, and as it should be. You know, the fund was about $20 million at the time. Let's see, had the building come online? The new building was online at that point, yeah. And so we just kind of swallowed all of that, and you know, we were really looking to figure out, okay, where do we go from here from an investment standpoint? So myself and a couple other folks from the Finance Committee and Chuck kind of got together with our investment manager, Luther King, and started kind of looking at our asset allocation, our mix of assets, and what we were going to do. But our investment objective is just to be very conservative. We wanted to beat inflation at that point was 2%. So it was just a kind of a low bar of how we wanted to manage this money. Vast majority of it was in cash and short-term bonds. Not a lot of equity exposure, maybe 20-30% at the time for a little diversification. But the real idea here was, you know, if this money is 10, 20, 30, 40-year money, we would typically invest more heavily into the equity market and use that as a tool, knowing that we're going to have some downswings along the way, but overall we should see it up and to the right kind of movement of the graph, and that's exactly what we've seen. You want to go to the next slide? So the mix is primarily determined of the portfolio's performance, and in knowing that, we significantly changed our asset allocation model. And what that is the board has directed a band of percentages for equities, for bonds, and for cash to our investment advisor, and they have to stay within those. Switch that slide. One more. So this is what we came up with. We came up with a domestic equity and an international equity allocation in the 55 to 65 range for domestic equities and 10 to 15% for international, for a total equity exposure of somewhere between 65 and 75. We gave them the leeway to go down to a minimum of 45% equities, which we've not gone back to since we put this new allocation in place. And our bonds will stay in kind of the 30% range. Now we do have what's called policy cash. We direct Luther King to keep at least 8% cash in the account, and that's just creates liquidity for a building project. It creates liquidity for whatever we need to do. We don't have to sell any investments to create the funds to do that. That number was at 10% when I came on the board, but remember the total investment portfolio was only $20 million. So policy cash at that point was $2 million. Now it's at 8%, so now we've got closer to $10 million in policy cash. And that may be a number that we want to look at as the value of that portfolio continues to increase. There may not be a need to keep that much in policy cash, but that's a decision for another board because I roll off at the end of the year. So that's how our portfolio is constructed, and those are the allocations that have been put in place. We've had some discussions along the way. I remember a lengthy discussion in February, March of 2020 when the world was shutting down and the markets were in turmoil, had gone down 20-30%. Maybe we've got too much in equities. We need to get money out of the equity market. And you know, my position on that and several others was like, no. I mean, that's exactly the wrong time to sell. I mean, we've got an allocation in place to get through these times, and thank God we didn't pull the trigger and sell at that time, because as you all know, within 5 or 6 months, the market was back to and above where it was, you know, in February, March of when COVID was going crazy. So, so we're set up really well. I will say that we have a great relationship with Luther King. Oh, you've got our allocations up right now. So you can see kind of where we are today. Our domestic equities at 52%, international at 4.2%, fixed income at 30%. We've taken a little bit more defensive position with where things are with inflation, you know, whatever's going on in Washington, we've just kind of, we see maybe some headwinds in the equity market, so we've pulled back a little bit there. And that's something Luther King is they're really nimble and able to help us with those things when things change. We don't tinker with this a whole lot. It's, you know, we've put these allocations in place for a reason, and it's worked well for us. So we do have a little bit more in cash. We've got about 5% in discretionary cash right now. I think that's primarily due to kind of what's going on with the building, and we don't know how much cash we're going to need to do all that, so we're being real conservative there. We don't want to have to sell anything if the markets were to go down. So that's kind of where we sit today, and that's an all-in allocation of all of our different funds. So when you know, it gets a little, Chuck went through all the different funds that we have, but those are really all kind of lumped together except for the Friendship Fund and the care fund.
Annuity.
The annuity fund. Those are two separate accounts. All the other money is in one investment account, but we segregate it on our books as far as what we've designated it for. So this is a great chart. You know, when you look at where we made the conscious decision to make a significant change in our asset allocation, it was in 2012, 2013, and you can see what the value of the fund has done, you know, over the last 10 or 11 years. It's kind of gone straight up and right, which is really what you're hoping for. So when I came on the board, we had about 20 million in the fund, and now it's, you know, at 120 million, and you know, positioned incredibly well, probably one of the best in the country from a financial stability of a CCRC. So that's due to Chuck and Sarah's leadership, as well as, you know, a strong board that was willing to make some good decisions along the way. So kudos there. So this is just a look at returns. Year to date's not going to tell you a whole lot. The since inception numbers are really the key, because this goes all the way back to 2012. And you can see, you know, returns up north of 6% gross, and 6.5 or 6.8, 6.5 net of fees. So speaking of fees, we did engage in an RFP process, a request for proposal process for investment managers about 3 years ago. We had been using Luther King for 8 or 10 years. They've been doing a great job. There wasn't any reason for us not to keep using them, but we felt it was our fiduciary duty to go out to market and see what else was available. If somebody else could do it cheaper, if they had better returns, you know, what was available out there. And with a $100 million fund, there was obviously a lot of interest. What we found, though, is Luther King has discounted their fee to about 25 basis points, which is a very good fee on an account this size. And their performance was as good or better than most of the people that returned a proposal. So we decided, made a decision to stay with Luther King. I do think at some point, you know, maybe in the next 4 or 5 years, the board probably needs to engage in that process again. I think it's always healthy to go out to market and see what's available out there, see if we can get a little better deal or get better returns, or what other ideas are out there. But just share that so you know that we're not, you know, Craig Hester's been a friend of mine for 30 years, and he's a great guy, and he does a good job. But we wanted to test the water and see if there's anything else out there that made sense. So what is that? That's our friendship fund.
Friendship fund, yeah.
Yeah. So this is the fund that would help anybody here at Westminster that qualifies to get in and ends up, you know, running out of assets. We've got a fund set up to help pay monthly cost on that, and as you can see, that fund had a change in their investment policy as well. There was a significant inflow of assets into that fund in
2008, my first year.
You did that personal contribution?
No,
Oh.
but we fundraised for it.
Okay, perfect. So I've got it up above $1 million, and it's continued to grow nicely, you know, over the last few years. So that's a great resource to have here, and I think it just shows, again, commitment to the financial security of the community. You know, our marketing team that brings people in, you know, I think they do a great job of verifying assets and making sure, you know, everybody passes all the check boxes, and you know, but sometimes things don't go the way you plan. So this is a great resource that.
And I would say that this fund continued to grow even when we had 4 or 5 people on the Friendship Fund. And, you know, there's been times that it continued to grow even then, so
Yeah,
it really is good.
That's great. So lastly, you know, the board takes our fiduciary responsibility very seriously, and, you know, y'all need to know that we have the discussions around all kinds of topics, but our finance committee is probably one of the most attended committees. It's probably the most engaged. Well, I shouldn't say that. Our food and beverage committee is great. Our facilities committee is great, but the finance committee has most attendance. Most of the board members that even aren't on the committee actually come to those just to kind of see what's going on, because it is such a big piece of what we've been tasked to do for you guys. And just want you to know that we take that very seriously. We look at increases annually. Look at that's very serious, because that's just more money coming out of your pockets. And we want to be able to show you a good return on that money, that you're getting good food, you're getting good services, you're getting quality leadership. Those are all the goals that we have as a board. And if we're not hitting those and y'all are not satisfied, we're happy to have a discussion about that and see what we can do to fix it. But anyway, just appreciate the opportunity.
So I received a few questions, and I'll answer those now. I get these a lot. So how's the budget monitored and tracked and adjusted? We get budget reports, and they're compiled monthly. They're provided to all the leadership, the board of directors, LCS management. All invoices are approved by me, as well as the directors. And then any variances monthly, if it's over $200, they have to do a variance report to myself, the accounting director, and the board of trustees gets a copy of that as well. Adjustments to the budget must be approved by the board of directors. Very few changes to the budget are made. Sometimes there's a project that was not anticipated in the capital improvement budget. For example, elevators in the Preston last year. We were going to work on elevators at the end of 2025. We started having problems with the Preston elevator, still are. And the board approved moving that project up and funding it from the replacement reserve. So that's typically when there's a budget change. How can you tell if a CCRC is financially viable? I think a lot of you maybe have friends that know you live at Westminster, and they're thinking about a CCRC, a retirement community. CCRC, Continuing Care Retirement Community. I'm talking abbreviations sometimes. So some of the things that you'd want to know when you do tour or look at a Continuing Care Retirement Community are, is the occupancy high? Above 90% ideally. Shows strong demand for the community, contributes to a stronger balance sheet. What are the bond ratings? Is it rated? Not every retirement community is, but some CCRCs have used public debt to finance their initial development. Renovations may have had their bonds rated by a rating agency. If they do, that's great. Try to get a BBB minus or higher because it indicates the financial strength of the organization. Are the financial covenants being met? So typically when you've gone out for financing, you have to meet so many days cash on hand, debt service coverage ratios. Ask the question, are you meeting your requirements, your covenants? If they're not, and they do that over a year, not meeting those covenants, and the third party can come in and actually start running the community. So it's really important that they stay well positioned and meet their bond covenants. Is there positive cash flow from operations? Meaning that, is it upside down? Did it make a margin? The for-profits want that, as well as the nonprofits. Everyone needs to make a margin. If they aren't making a margin, they're going to come after who? The residents to pay the bills, right? Because if they're not making a margin, they need to produce one. there's going to be an increase in the monthly service fees to help offset those differences. Make sure that their operating revenue is exceeding operating expenses. What does Westminster pay for how does Westminster pay for unexpected projects? I mentioned the replacement reserve fund, and there's approximately $12 million in that account today. Every year, at the end of the year, we look at net operating income and make decisions on where to put those funds, that net operating margin. And we've kept the replacement reserve well funded. So if we have a project that hits the replacement reserve, we look at that fund and reimburse ourselves, move that money around to make sure that that fund stays strong. What triggers a budget change? Not a lot, thankfully, which means that, we're looking into the crystal ball, kind of trying to figure out what we anticipate in the coming year when we put the budget together. What are the expenses going to be? I didn't see the price of eggs going up as much as they did. I think we budgeted 8 to 10%, but butter and all of those things really went up. Yeah, blueberries. Yeah, we had a big discussion in the board meeting because I keep track of all these things. I'm signing off on the invoices as well as department directors. Blueberries were $59 a flat. So a flat is 12 quarts of blueberries. And you all love blueberries. And they're great for you, don't get me wrong. But I'm looking around at the fruit cups and I'm like, why is there 16 blueberries in that fruit cup? So, I'm telling the board that we're gonna have to cut back on blueberries. Raw food is above budget. But typically, we have a contingency that we always budget for capital expenses, around $200,000. At times, we'll delay a project for like a replacement project. For instance, one year, a few years ago, I had planned to buy a new bus. And our old bus wasn't great, but it was doing fine. And we needed the money for an air conditioning project that I didn't plan on. So I asked the board to reallocate the funds for the bus to pay for the air conditioning project. And they did, of course. And we were glad that we got the air conditioning and we needed it. So things like that occasionally happen. Mostly we don't have to make a lot of changes to the budget because we're doing a really good job of putting together a capital expense budget, which is typically around $4.5 million in capital expense improvements. About 1.2 of that is just refurbishing apartments, and then you've got lots of projects going on around the campus, like the Preston electrical switches being replaced. That was a project that was paid for through the capital expense budget. So most things, we're doing a really good job of forecasting and staying ahead of it. We don't have deferred maintenance. We are really trying to address things as they appear on the horizon. So, and the board has been very supportive of that. What is the difference between a for-profit community and a not-for-profit community? The thing across the street, is it a for-profit or not-for-profit? Did I say thing? I shouldn't have said that. You've told me mediocre living though, so yeah. So it's a for-profit, right? What does that mean? Well, they're responsible to corporate investors and shareholders who are interested in making money on their investment, not necessarily the needs of the residents, right? Typically, organizations that are for-profit are a little bit more unstable. When the economy has fluctuations, the housing market has fluctuations, they don't do quite as well. And so then their occupancy starts to fall off. And then they have to make up the revenue somewhere. And so where do they get the revenue? From the residents, right? Where the non-for-profit like us is more stable and we have more resources available because the board has made good decisions and we have those resources so we can absorb the fluctuations in the market better than the for-profits typically. No community oversight. Sometimes, many times, they're overseen by corporate investors in an office in another city and state. LCS, Life Care Services, who I work for as a management company, they have what they call equity communities, for-profit communities across the country. They're based in Des Moines, Iowa, and they don't always know what's going on in that region, right, as well as we do, or what's going on in the state. For-profits many times are inferior quality because they're worried about the bottom line and they're not staffing as well as Westminster does, or other non-for-profits. And so Westminster's barometer and the barometer of the board is really the quality of Westminster and the services we're providing, the health care that we're providing. That's our barometer. That's when we know we're being successful. And if we take care of the people, the bottom line takes care of itself, right? That really does work. And it has here for a long time. That's all I have. We'll open up to questions now. We have about 15 minutes. Yeah.
That was a very encouraging and reassuring report. One question I had, the basic question, I'm back here,
Okay.
and is what's the relationship between LCS and Westminster?
We get along really well. Wait, so, okay, Life Care Services is a management company who I work for. So they bring you me and Sarah and, aw, thanks. I've got one fan out there that's so good. So they bring you me, Sarah, and Cassie, our community administrator. Life Care Services provides us software programs. They also have a group purchasing organization, an insurance organization. They provide us marketing support, operational support, collateral support, my boss and my boss's boss. And so, for instance, by being a partner with LCS, by LCS managing us, we're able to participate in group purchasing. And so it saves us money on raw food and supplies and equipment. They also have an insurance program that we're able to participate in. And if we went outside of LCS, we call it LCS Advantage, if we went out there and purchased our own insurance on our own, we might pay more, about 40% more than we pay currently, because we're able to partner with LCS and purchase the insurance product through them. Because there's 150 communities across the country, the cost and risk are spread out amongst all those communities, so it really does help us save money. A lot of the guidelines and policies and procedures come from LCS. We're not on their radar very much because we're doing a really good job here operating Westminster, as you know. So we're low maintenance, but LCS is there if something happens and we needed help in any way. They would be here to support Westminster and the port. So, a management company that Westminster, the board, pays to provide management service on the day-to-day operations for Westminster. And I'm part of those operations. Did that answer your question good? Okay. We're not owned by LCS. I know that's sometimes confusing. We're not owned by LCS. Westminster is its own not-for-profit entity, 501c3. It's set up totally independent. The board hires LCS to manage Westminster, and has been since 1981. And prior to 1981, Westminster was kind of in a bad way. It was having trouble meeting its financial requirements. It actually was having trouble making payroll. And so LCS came in and helped obtain a loan of about $1 million, brought that back to Westminster, helped them cover payroll and some expenses that were kind of out of line. They were behind on paying, and then rewrote their contracts to the type of contract that you're signing today, or you signed when you moved in. And so it really helped change Westminster and operate more efficiently. And we did pretty, much better through the 90s, and then, you know, the 2000s, 2008 and on, it's been highly successful, so. Yes, sir.
Do you have a plan to increase the rating from triple B?
Yes. Yeah, I think, you know, I'm really mad at Fitch, and Sarah knows, I sent them one of the angriest emails I've ever sent anybody probably, and I don't know that helped us a whole lot, because they, you know, a triple B stable is what they rated us. And we truly, you saw the metrics, right? We're double every single financial metrics or more to achieve a triple B plus. And so we absolutely did. You know what bothers Fitch is that we have a competitor opening up across the street, and that we're going to construct a non-revenue generating project. And even though that non-revenue generating project is part of the strategic plan that we've been working on for 7 years, and it's a great plan, and it repositions our community for the future in such a grand way. Excuse my pun there. But it's really extraordinary. And Westminster is already one of the best CCRCs in the country. Not only from a financial standpoint, but from a quality standpoint as well. And higher resident satisfaction, there's so many metrics that are measured that I can share with you, and I do share with you. So yes, absolutely, it's our goal.
That's enough. You can tell Chuck is very passionate about the rating. All I can say is the rating affects us when we go out for financing, right? That's really the only time it has really any impact. And what happened on Wednesday is the market said, you guys are triple B plus. Like, we were planning to go out at 5% on these bonds with not a whole lot of premium on the long end of the curve. I don't want to get too deep in the weeds. The bottom line is, that was our pre-call pricing. When they actually tested the market Wednesday morning, there was so much interest in the bonds at that level that they actually ratcheted it up and made them and put a bigger premium on the bonds. Meaning we had to sell less bonds to get the same amount of money, right? So the market gets it, and those are the people that we need to get it, not Fitch, right? But it's disappointing to Sarah, Chuck, and to the board. But
Yeah. And I'm trying to get over it.
it'll be okay.
Question?
All the way in the back.
Yes, thank you so much for a wonderful presentation. My question is, how much is Phase 4 going to cost? I may have missed the numbers.
The total for Phase 4, this is furniture, fixtures, everything, is $43 million.
I see. Okay, thank you.
I would say about $9 million of that is electrical upgrades on the Windsor and Preston. Yeah. New generators and stuff, they're gonna be beautiful if you like generators. I do, but, yes.
Yes, it has recently been a big improvement, quote, in the central elevator in Preston. However, the initial reaction seems to be the upgraded elevator fails as frequently as the old one did. Do you have any comment on this?
That's a true story. Yeah, I don't know why. We've met with TKE, Tyson Crump, to address it, and they will work on it until it's fixed and made whole. And all of this work is being covered under the warranty, but you're absolutely right. It is, I'm like, did you guys buy this at the used elevator store? Because it's not good, and it needs to be worked on and corrected, and they're working on that diligently. Yes.
Any further questions? Any further questions?
Can we get a copy of the presentation that's provided?
No, yes, of course. I will put it on the resident portal,
Good.
and you can get it from there, yes. Don't share it with our competitors, though.
Just a quick question. I noticed that the recent bond issue, that they're callable. Is that typical for the market that we're in, that they would be?
Yeah, typically we put a call on it just in case we want to get out of that debt. The call's at a premium, so we've got to pay a premium to the bondholders to get them back if we want to call them. Now, we didn't call any bonds when we went and repurchased this recent tranche. What we did was we went out to market and actually bought them. We were just bond buyers because the bonds were trading at a discount. Does that make sense? Yeah, so the call date just gives us the opportunity, and we're using some of that on our 2016 bonds. We're actually calling some of those with some of the proceeds from this bond sale to refinance those, and we are paying a bit of a premium on those. But that factored into our financial decision to actually it'll save us money over the long haul to call those bonds.
And we will continue to look for opportunities to refinance, which we did in 2016 and saved ourselves about $14 million over the life of the loans, or the life of the bonds. So. And we'll do that with this as well. If the bonds interest drops significantly, we're definitely going to spring into action and try to refinance and save us money. We continually do that.
Do you have any crystal ball on the impact of tariffs?
On the construction project? Well, do we have a crystal ball on what the tariffs are going to do to us? I can tell you that we're trying to get ahead of the tariffs on the project, the construction project. One of the reasons we're trying to finalize the contract with White Construction so they can go out and purchase the steel ahead of that tariff that's coming. And then, of course, you know, we're already seeing some talk about it affecting the price of kitchen equipment and things like that. So definitely is going to make an impact, and it's already starting to. Yeah. But I think we're well positioned to get ahead of it on the construction project.
Any further questions? If not, thank you both very much.